Hey out there, welcome in, welcome to another exciting, ravishing edition of Market Takes. Listen, I know you could have been anywhere in the world, but you are right here with me on Market Takes. I appreciate that. I'm your host, Dion Rabouin, reporter at the Wall Street Journal. Listen, there is a lot going on out there in the world. We are bringing you the three big things that you need to be watching out for this week. We're going to tell you what those are, why they matter, and why it's meaningful to the market, the economy, all that good stuff. So listen, first, we are fully into earnings season at this point, but we have a big week this week. A lot of big tech names are reporting, some banks. We've got a big mix. We're going to tell you all about what's happening and tell you what the most important earnings reports are to watch out for in terms of what that could mean for the market, to investors, and overall to the economy, big picture. Second, we get the first look at U.S. first quarter GDP. If you remember this time last year, people weren't really talking about the GDP report, then it came in negative, was wildly unexpected, much lower, and that led to a lot of concerns that the US was already in a recession. Those fears have kind of abated, but this first quarter GDP report comes with a lot of questions. We are going to get that, and that's going to answer a lot of questions about the economy. Third, we get the two major reports on consumer confidence and sentiment this week. I'll tell you what those are, what to look out for in each of those. So without much further ado, let's get into it. Earnings. Listen, we've already kicked things off this week. This morning, we found out that Credit Suisse lost more than $68 billion last quarter, excuse me. That was more than expected. They also borrowed more from a central bank liquidity backstop than had been originally thought. Basically, that just means that Credit Suisse was in more trouble than we expected, than what we thought. Writing down a lot of that debt. That highlights some of the challenges ahead for UBS. You remember UBS acquired Credit Suisse in that kind of last minute, last second deal where they acquired it with help from the Swiss government. That was a big deal, and this now looks like, man, things could be even worse for UBS. Maybe Credit Suisse and those bad assets drag down UBS more than worried about. I want to read a quick quote here from some analysts at KBW. They said, quote, "The revenue trajectory is so damaged that the deal could well remain a drag on UBS operating results until a deeper restructuring plan is announced." All that means is there could be more trouble maybe now at the bigger banks. We heard from some of those big banks last week. They look good. JP Morgan Chase, if you remember, $52 billion in profits. Big numbers, big names. So a lot of those big banks could be in solid condition over here in the US. But then you look over there at Europe, well, maybe there are bigger problems. Keep that in mind. We are going to hear this week from First Republic Bank. Now, if you're familiar with that name, you're like, why have I been hearing about First Republic? It's because that's really been the subject of a lot of targeting. The stock has just been plummeting, falling off a cliff for a while. And investors, it's been one of those banks that investors have been worried about for some time. Its stock price has tumbled, its market value has tumbled. We're going to hear from them what actually happened at the bank, how are they holding up, and that'll be a big piece of this overall bank picture. We're going to talk about that in just a minute. There have been some big winners and big losers overall from these earnings reports already. Last week we heard from Western Alliance that said outflows, they lost a lot of money in deposits, but that stabilized and they actually rose $2 billion at the end or at the first half of April. That stock up 24% last week. Metropolitan Bank deposits fell 3%, but they kind of chalked that up to crypto losses. Less than expected. Stock rose 15% for the week. On the other side of that, some big losers. Truist Bank, another one of those kind of regional behemoths that was created by the combination of BB&T and SunTrust. Deposits down 5% from a year earlier and down 2% from the previous quarter. That stock was down 5% for the week. KeyBank, another one of the bigger regional banks. Deposits down 3% from a year earlier and down 1% from the previous quarter. Those shares were down 5% last week. So while you did see some stocks do better than expected or some banks, really the overall mood from investors was still negative on the banking sector. And I want to put a chart up here on your screen that really kind of tells us what's so important about this earnings week. Now, the line you see up there at the top that's skying above all the rest, that's the NASDAQ 100. That's those big tech names. You're talking Meta, you're talking Amazon, you're talking Microsoft. All those big, huge, massive, some of the biggest countries, some of the biggest companies, in the US overall, that's what that is. And we've seen investors move into those big tech names and out of some of the others. That's why it's doing so much better than the S&P 500 so far this year, because investors are really just seeking out the safety, or at least the supposed safety. It seems a bit like an oxymoron, right? Because tech is generally thought of as risky, as a place where you might lose a lot of your money, but investors have been kind of moving into the big tech names as a safe haven, thinking that they're too big to fail in a matter of speaking, and that's why the NASDAQ has done so well this year. The S&P doing pretty well, about 15% year to date, but not quite as well. And then you see on the lower half, that number that's down about 20% year to date, that's those banking stocks. And even though you did see news that wasn't as bad as expected, that wasn't worse than expected, investors still selling banks, not buying in yet. You have not seen Wall Street change its mind about the big banks, and that's what's there. So that chart illustrating just the way that Wall Street has been thinking about the overall state of the economy. Banks down and out, tech doing pretty well. Here's why this week could be such a big piece of that, or could change that narrative. We've got a lot of money flowing into big tech. A lot of the thinking is, well, these companies are too big to fail, but they've also been announcing a lot of layoffs, doing a lot of things to kind of patch up that bottom line, right? Show that they're making money, doing what Wall Street wants, bringing in the dollars. We're going to find out if that actually happened. Did those layoffs actually create meaningful profits for these big tech companies? We are going to hear from Microsoft, Alphabet, Amazon, and Meta all this week. That's going to tell us a lot about what the state of the economy is. Now, Wall Street Journal, we exclusively reported last week that Meta CEO Mark Zuckerberg had announced that they weren't going to promise no more layoffs. They've already had huge layoffs affecting about a quarter of the company. And Mark Zuckerberg saying, we might just have to do more layoffs. So keep your eye on those tech earnings. That could, if that bull falls out of tech, you could see the stock market overall move meaningfully lower, and that could be some negative overall news for the US economy, especially as we've seen layoffs start to pick up here, as we've seen jobless claims pick up and all those other things. Other companies to watch this week, you got Exxon and Chevron, the big oil majors here in the US, Johnson & Johnson, Pfizer, McDonald's, Verizon, T-Mobile all this week, as well as Visa and MasterCard, so watch out for those. GDP coming in this week. Want to put a chart up here on your screen that just shows you what we've seen from GDP. Overall, you see over here to the right of your screen, you saw those 2 negative quarters of GDP contraction that we talked about at the beginning of 2022. Then GDP picked up, getting back in line with trend. Expectations are for GDP to come in under 2% for the first quarter, about 1.8%. This chart is illustrating the overall long-run theme. When you take out those pandemic swings, 2021 was a big year, but now we're expecting lower growth and less than 2% growth this first quarter. Ernst & Young, or EY, chief economist Greg Dako put it this way. He said, the economy capped 2022 with pride, but enters 2023 full of doubts. I think that's a lot of the worry here. And if that number comes in below expectations or even negative, again, that's going to raise a lot of fear about the U.S. economy. There are a number of reasons to be worried that that GDP figure could come in negative, even though Atlanta Fed GDP now is showing 2.5%, way up from 0.7% increase expected. So keep that in mind. Last chart I want to put up here on your screen, and we want to put that up right now to show you consumer confidence. And this is the University of Michigan's Consumer Sentiment Index, and as you can see, it's been moving higher. That's good news. It means consumers are feeling good about the economy. It's part of why we've seen spending continue. But as we are seeing rising gas prices at the pump, as we are seeing higher oil prices, as we are seeing higher housing costs, will that continue? And that's going to be a big part of the overall theme that we will see. Can those things continue? That chart just illustrating the overall change that we have seen in consumer confidence that had really plummeted and bottomed out, and now we've seen a pickup there. Conference Board and the University of Michigan both released their consumer confidence and consumer sentiment. Basically, Conference Board has a larger sample, they survey more people, but the University of Michigan has more detailed questions. University of Michigan consumer sentiment is really, how are you feeling? What are you thinking about the economy? How do you feel personally? Whereas the Conference Board is, what do you think about business? How are business conditions doing? They also look at, the Conference Board is better at picking up on indicators related to the job market and job security, while the University of Michigan survey, much more a measure of pocketbook issues. How are you doing in your life? University of Michigan survey is expected to rise to 63.5, up from last month. Conference Board expected to decline. You'll want to watch both of those. Listen, that's going to do it for us here on Market Takes for this week. We will be back with you again on Monday, looking ahead to what you need to be looking out for that week. But until then, thank you so much for being with us. I am Dion Rabouin, reporter at the Wall Street Journal, and we will see you next time.